Let me start with a surprising reality. SCHD currently yields around 3.3%. Meanwhile, 10-year Treasury bonds are paying roughly 4.5%, and some high-yield savings accounts are offering close to 5%. In other words, you can earn more income today from cash or government-backed securities than from SCHD, and do it without stock market volatility or investment risk. That raises an important question. If safer options are paying more, why would anyone choose SCHD? It's a question many dividend investors are asking right now. On the surface, Treasuries and savings accounts seem like the obvious choice. Higher yield, less risk, and no worrying about market swings. But the answer isn't as simple as comparing today's yield. There's a bigger picture that most investors overlook. In this video, we're going to look at the real numbers, the trade-offs, and the long-term implications of both choices. By the end, you'll have a clear understanding of whether SCHD still deserves a place in your portfolio, or if taking the risk-free yield is the smarter move for your situation. Here's what we're covering. First, we'll compare the actual numbers. What SCHD, Treasury bonds, and high-yield savings accounts are paying right now. No estimates, no assumptions, just the current yields. Then we'll discuss the one critical factor that simple yield comparisons miss, and it's the main reason SCHD continues to attract long-term investors. After that, we'll look at taxes, because what you keep matters more than what you earn. Finally, I'll give you a clear answer on who should consider owning SCHD today, and who may be better off sticking with risk-free alternatives. Quick disclaimer. This video is for educational purposes only and should not be considered financial advice. I'm not a licensed financial advisor. The yields and rates discussed are based on currently available information and can change at any time. Before making any investment decisions, do your own research and consider speaking with a qualified financial or tax professional who understands your personal situation. Let's start by comparing the income each option provides today. SCHD currently yields about 3.3%, so a $100,000 investment would generate roughly $3,300 per year in dividend income. Treasuries, however, are offering higher income at the moment. A 10-year Treasury yielding around 4.5% would produce approximately $4,500 annually on the same $100,000 investment. High-yield savings accounts are also paying between 4.5% and 5%, generating roughly $4,500 to $5,000 per year, while keeping your money easily accessible and protected. If we look only at today's income, SCHD comes up short. Both Treasuries and savings accounts currently offer higher yields with lower risk and less volatility. For investors focused strictly on generating the most income right now, risk-free options have the edge, but that's only looking at one side of the equation. Yield shows what an investment pays today. It doesn't tell you what it could pay in the future. The real question isn't just how much income you receive now, but whether that income can grow over time. That's where SCHD and other dividend growth investments begin to separate themselves from fixed income alternatives. A basic yield comparison overlooks the factor that matters most: income growth. A Treasury yielding 4.5% provides steady and predictable income, but that income stays essentially the same. A $100,000 investment might generate about $4,500 per year today, and years later, you're still earning roughly that same amount. When the bond matures, you receive your principal back, but there's limited growth potential along the way. High-yield savings accounts face a similar challenge. While rates may be attractive today, they can decline quickly when interest rates fall, reducing the income you receive in the future. SCHD operates differently. Its starting yield may be lower, but the companies it holds have a history of increasing their dividends over time. Instead of a fixed income stream, you have the potential for income that grows year after year. There's also another advantage: capital growth. Unlike Treasuries or savings accounts, SCHD owns businesses that can increase in value over time. Historically, the combination of rising dividends and share price appreciation has helped investors build more wealth over the long run. That's the trade-off. Treasuries and savings accounts offer higher income today with greater stability. SCHD may start with a lower yield, but it offers the possibility of growing income and long-term portfolio growth. The question comes down to your goal. Do you need the highest income today, or are you willing to accept market risk for potentially greater income and wealth in the years ahead? There's another piece of the puzzle that many investors forget about: taxes. Looking only at yield can be misleading because different types of income are taxed in different ways. Treasury interest is generally taxed as ordinary income at the federal level, although it's usually exempt from state income taxes. Interest earned from high-yield savings accounts is typically taxed as ordinary income at both the federal and state levels, which can reduce the amount you actually keep. SCHD works a little differently. Most of its payouts come from qualified dividends, which are often taxed at lower long-term capital gains rates instead of higher ordinary income rates. Because of that, SCHD's after-tax income can be more attractive than its headline yield might suggest. When you account for taxes, the income gap between SCHD and higher-yielding alternatives often narrows. Treasuries and savings accounts may still provide more income today, but the difference isn't always as large as it appears on the surface. The type of account you use also matters. Holding SCHD inside a tax-advantaged account, such as a Roth IRA, can allow dividends to grow tax-free, helping you keep more of your returns. The key takeaway is simple: don't compare yields alone. Compare what you actually keep after taxes, because your after-tax return is what truly matters. So who should consider owning SCHD, and who may be better off with safer options? If you'll need your money within the next few years, are saving for a major purchase, building an emergency fund, or simply don't want to deal with market volatility, high-yield savings accounts and treasuries are often the smarter choice. They may not offer the same long-term growth potential, but they provide stability, liquidity, and more predictable returns. The same can be true for retirees who rely heavily on their investments to cover everyday expenses and prefer avoiding significant fluctuations in portfolio value. In those cases, protecting capital may take priority over seeking higher growth. SCHD tends to be a better fit for long-term investors with a time horizon of 10 years or more. If you don't need the money anytime soon and can remain invested through market ups and downs, SCHD offers the potential for growing dividend income and long-term capital appreciation. For many investors, the best solution isn't choosing one or the other, it's using both. Keep emergency funds and short-term savings in cash, savings accounts, or treasuries where safety matters most. Then use investments like SCHD for long-term goals, retirement planning, and building future income. The goal is to match each investment to its purpose. Cash and treasuries provide stability and access to your money, while SCHD is built to help grow both income and wealth over time. So why would anyone own SCHD when treasuries are currently paying more? It really comes down to your time horizon and investment goals. If your priority is earning the highest possible income with minimal risk over the next few years, treasuries and high-yield savings accounts are excellent options. They offer higher current yields and a much more predictable experience. However, investing for the long term is about more than the income you receive today. A treasury typically provides fixed income with limited growth potential. SCHD, by contrast, offers the possibility of both rising dividend payments and long-term price appreciation. While the starting yield may be lower, the income generated by SCHD has historically grown over time, and the value of the underlying investment has had the potential to increase as well. That's the fundamental difference. One is built for stability, while the other is built for growth. With interest rates still relatively high, Keeping large amounts of cash in a low-interest savings account often isn't the most effective choice. Moving idle cash to a competitive high-yield account can make sense. For money that won't be needed for many years, SCHD may provide stronger long-term opportunities. The biggest mistake isn't choosing Treasuries or SCHD. It's leaving your money sitting idle and allowing inflation to gradually reduce its purchasing power over time. To sum it up, Treasuries and high-yield savings accounts currently provide higher income with less risk. SCHD offers a lower starting yield, but it comes with the potential for dividend growth and long-term capital appreciation. Cash and Treasuries are generally better for short-term needs, while SCHD is designed for investors focused on building income and wealth over the long run. And once taxes are considered, the difference in income may not be as large as the headline yields suggest. So what's your choice today? SCHD or Treasuries? And how long is your investment timeline? Subscribe for more dividend investing insights and SCHD updates. Thanks for watching, and I'll see you in the next video.